Both of these industrial REITs yield above 6%, but one fails three of my balance sheet gates completely. If you hold either for retirement income, you need to see what the balance sheet is hiding right now. Today, we put two of the biggest heavyweights on the Singapore Exchange under the microscope to see if their income foundations match their blue chip branding. I had to run the numbers twice on these industrial giants because the market is treating them like safe havens at record highs. My role is straightforward, even if the balance sheet is not. I look past the headlines to check the markers that matter: interest coverage, gearing, and free cash flow sustainability. That way, the retiree in Singapore building or living off a dividend portfolio gets the same forensic clarity that institutional investors rely on without needing a Wall Street microscope. When you look at a yield that clears 6%, it is incredibly easy to turn a blind eye to structural risk. But for retirees who rely on dependable drawdown income, a high headline number is never enough. We have to treat these financial reports like medical health screenings. I check these metrics thoroughly so retail investors building dividend portfolios get the exact same forensic clarity that institutional players take for granted. Turning our attention to the immediate issues, the red flags are not hidden in the business models themselves, but deep inside the leverage ratios. Let me be entirely clear about who should be worried here. Growth chasers who want momentum might look at these metrics and decide the balance sheet tension is perfectly acceptable for capital gains. But retirees focused on wealth preservation and dependable drawdown income should absolutely not look past these risks. My forensic standard, built around a 4.7% minimum yield hurdle and strict balance sheet gates, is designed to protect your core principle. We need to evaluate whether these income foundations can actually hold up. We are standing at the final trading day of the first half of 2026, and the STI is consolidating right near record highs. In a market regime operating above 5,000, retail investors naturally follow the crowd into names they assume are completely safe simply because trading volume is massive. For the week ended 26 June 2026, CapLand Ascendas REIT alone saw 88 million units move, making it a top active counter along with Mapletree Industrial Trust. But record high valuations demand non-negotiable balance sheet discipline for incremental buying. What makes these two counters so attractive to the public is their massive scale and incredible corporate backing. Both are industrial heavyweights aggressively shifting toward digital infrastructure, both clear my minimum 4.7% yield hurdle, and both are backed by powerhouse sponsors in CapLand Investment and Mapletree Investments. But sponsor depth does not mean we ignore the foundations. The ultimate question is whether the distributions they pay are stable enough for retirement capital at current peak market pricing. Let us look directly at the distribution data for CapLand Ascendas REIT. For the full financial year 2025, the DPU came in at 15.005 cents. At a unit price of $2.46, that gives retail investors a trailing yield of approximately 6.10%. This clears our house minimum hurdle by about 140 basis points, which looks fantastic on paper. However, the direction of travel is down, with the distribution falling 1.3% year on year. Switching over to Mapletree Industrial Trust, the headline yield looks even more generous at first glance. Its full-year DPU stands at 12.71 cents, which translates to a trailing yield of 6.58% at a stock price of $1.93. This beats our hurdle by 188 basis points. But the underlying trend shows a much sharper decline, with the DPU dropping 6.3% year on year. Even if you back out a prior divestment gain for a true comparison, the drop is still 3.2% due to vacancies and foreign exchange headwinds. For an investor drawing down on capital for daily living expenses, a 3 to 6% annual distribution decline is a serious threat. Over a 5 to 10 year horizon, these drops compound into a very real income shortfall. The high yield you buy today does not guarantee your income 3 years down the road. When you look back over a 5-year window, CapLand Ascendas REIT has been broadly flat with a mild wobble, whereas Mapletree Industrial Trust has round-tripped its growth entirely, landing below where it started. Looking at the verified 5-year distribution trend side by side highlights this trajectory clearly. CapLand Ascendas REIT moved from 15.260 cents down to 15.005 cents, showing real stability but zero growth. Mapletree Industrial Trust went from 13.58 cents peaked and has now slid down to 12.71 cents. These figures are aligned by sequential financial years to give an accurate comparison. This long-term trend lines up perfectly with the structural issues emerging in the leverage profiles. This is where the structural paths of these two trusts split wide open under our forensic lens. CapLand Ascendas REIT filed an aggregate leverage of 42.0% as at 31 March 2026. This is a clear hard gate failure against my strict 35% house ceiling. Management points to a pro forma leverage of 37.3% following their $903.5 million equity raise. But independent broker research pins it closer to 39.7%. Every number in that range breaches our safety standard. Mapletree Industrial Trust presents a very different leverage profile today, filing a gearing ratio of 34.0% as at 31 March 2026. On paper, this technically passes our 35% ceiling, but look closer at the timeline. This filed number was recorded before their May 2026 redemption of outstanding perpetual securities. Management's own guidance shows that once that redemption is accounted for, pro forma gearing will rise immediately to approximately 37.5%, pointing directly toward a breach. Income safety is entirely dependent on a trust's ability to pay its interest expenses comfortably. CapLand Ascendas REIT reported an interest coverage ratio of 3.4 times on a trailing 4-quarter basis, failing our 4.0 times minimum safety floor. Its average cost of debt is 3.5% with a maturity of 3.1 years. Mapletree Industrial Trust delivered an interest coverage ratio of exactly 4.0 times, a marginal pass right on our razor's edge. The big worry here is that 42% of its debt matures across the next 2 financial years. Reviewing the full financial health checklist summarizes the balance sheet tension clearly. Both trusts pass the trailing yield hurdle easily. But on file gearing, CapLand Ascendas REIT fails while Mapletree Industrial Trust passes. Look at the pro forma row and both fail our house standards. On interest coverage, one fails and the other passes marginally. Most importantly, both fail our prime asset portfolio occupancy floor of 95%. Let us put these metrics into perspective by looking at how they map onto our structured rating zones. To give retail investors absolute clarity, every counter I analyze is mapped onto a 5-zone system. Zone 1 represents fortress retirement-grade assets with yields above 5.5%, low gearing, and massive interest coverage. Zone 4 is the caution zone, where a counter fails at least one of our mandatory hard gates. Because of its structural leverage breach, CapLand Ascendas REIT sits firmly in Zone 4 today. Mapletree Industrial Trust lands in Zone 3, meaning conditional grade, clearing yield but carrying multiple balance sheet flags. Both of these massive trusts are experiencing notable asset utilization pressure, falling well short of our 95% floor. CapLand Ascendas REIT recorded a total portfolio occupancy of 90.5% as at 31 March 2026. While its domestic Singapore properties remain highly stable, the real operational drag is heavily concentrated in its overseas logistics and European business parks. To counter this, management is expanding, taking a 49% stake in a Greater Osaka data center. Mapletree Industrial Trust posted an overall portfolio occupancy of 91.2% for the period ending 31 March 2026. The primary operational drag here is its North American data center portfolio, which has been hit hard by recent major lease non-renewals. This reveals a massive structural reality for retail investors. Because Mapletree Industrial Trust is much further along in its digital transition, its core earnings engine is fully exposed when that specific niche experiences volatility. Mapletree Industrial Trust exposes a critical lesson about chasing popular sector trends blindly. For years, retail investors cheered the aggressive pivot into premium data centers, treating it as an automatic growth driver. But when North American tenants walk away and vacancies spike, that high-tech engine stalls quickly, because data centers represent a larger portion of its assets. These lease non-renewals drag overall occupancy down to a weak 91.2%. The transition is advanced, but being advanced means you take the full force of the headwind when the wind shifts. Operational focus must override structural narratives. In a peak market regime where valuations are stretched to the absolute limit, individual retail investors are highly vulnerable. The difference between finding an income sanctuary and stepping straight into a dangerous yield trap can be decided in a single trading session. While free subscribers are left reading yesterday's news, IGGY'S elite investors are collaborating in real time, sharing data-driven analysis to protect their hard-earned capital before the broader market can react. Members of IGGY'S elite investors do not just receive these forensic reports early. They get the comprehensive operational breakdown the exact moment it is finalized, featuring 0-day access, our restricted red zone watchlist, and institutional-grade cheat sheets built around this exact 5-layer audit process. For a subscription fee of $9 a month, which is less than a basic kopi and kaya toast set at Raffles Place, you stop acting as the market's exit liquidity and start processing data like a professional analyst. Let us look at how the institutional broker community views these counters relative to market prices. For consistency, I am anchoring both names to a single data vendor, TipRanks, rather than blending multiple feeds with different methodologies. CapLand Ascendas REIT carries a current price of $2.46 with a consensus rated positively by brokers, implying a target price up to $3.26. Mapletree Industrial Trust sits at $1.93 with a consensus rated neutral by brokers and a target of $1.90. Let's look at what the consensus is saying. For CapLand Ascendas REIT, broker coverage is calling a strong buy, with healthy double-digit upside implied. The market is treating it like a safe haven, expecting capital appreciation on top of yield. For Mapletree Industrial Trust, the consensus is far more cautious. The target price actually sits below the current market price. That lines up with what we see in the numbers: razor-thin interest coverage, an occupancy miss, and a declining DPU trend. In other words, the market is not pricing in near-term capital appreciation. So the takeaway is clear. Consensus sees Ascendas as a growth plus income play, while Mapletree Industrial is being treated as a hold. For retirees, this is a reminder that even when yields look similar, the market's confidence in balance sheet strength and future growth can diverge sharply. The institutional numbers show a massive gap between these two heavyweights. Brokers see significant capital appreciation potential for CapLand Ascendas REIT, projecting an upside of over 30%. For Mapletree Industrial Trust, the consensus stays neutral, with a target price sitting below current market levels. This lines up with everything our audit has revealed: the declining distribution trend, the thin interest coverage, and the vacancy issues. The market is clearly not pricing this name for near-term capital growth. CapLand Ascendas REIT's recent $903.5 million equity fundraising is an aggressive move that creates a massive short-term drag for existing income holders. While management guides that pro forma gearing will fall to 37.3%, the hard truth is that this figure has not yet materialized on a filed SGX balance sheet. We are forced to wait for formal accounting verification while absorbing a 1.3% year-on-year DPU decline. Chasing scale is fine for a sovereign fund, but a retiree cannot buy groceries with pro forma projections. The current balance sheet remains firmly outside my comfort zone. To ensure our income streams can survive severe market downturns, we must maintain an incredibly strict stress test standard. I apply a conservative asset floor rate of 3.2%. Even though the 6-month T-bill has dipped to about 1.48%, I do not lower our criteria to match temporary market changes. Adding a mandatory 150 basis point risk premium to that floor gives us our rigid 4.7% minimum yield hurdle, proving that high yields must always be backed by solid fundamentals. Summing up the forensic data, both industrial giants clear our yield hurdle easily, but neither manages to pass every essential safety gate. CapLand Ascendas REIT remains in our caution zone. While its sponsor strength is completely undeniable, its leverage, interest coverage, and occupancy metrics are flashing clear warning signs. To move this counter up our tracking ranks, I need to see gearing confirmed below 38% and interest coverage recovering back toward 4.0 times at the next earnings update. Mapletree Industrial Trust is assigned to our conditional zone. The balance sheet appears structurally stronger today, but the downward distribution trend and razor-thin interest coverage demand caution. Management must prove clear releasing timelines for their North American data centers before we commit further capital. For a 60-year-old investor in BIDOC drawing down on SRS capital, relying blindly on headline yields without monitoring these balance sheet shifts puts your monthly copy money at serious risk. Take care of your principal and look closely at the foundations. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get 0-day access. Link in the description. Join Iggy's Elite Investors today to secure early access before the broader market reacts. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. Stocks flagged as growth watch fall below this threshold, but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.